think two factors in the last few weeks have made a difference. One is the revision of the GDP numbers, because before the revision, we saw that consumers were spending faster than their income was growing. And you can be optimistic on consumers, that's okay. But if the income is not there, then it looks unsustainable. That has changed. Income growth is now stronger than consumption growth, which makes it more sustainable. And the second is the labor market numbers. There's also always a bit of worry about the labor markets. There are signs of cooling, but those labor market data were pretty strong. So I think those two factors for the U.S. economy, which were reasons for concern, reasons for a growth slowdown, maybe a bit too much. That is also quite a difference, and I think that also underpinned the market strength that we see at the moment.
Yeah, that market strength, though, if one was to take a look at words or comments then even by the likes of Christopher Waller yesterday, just speaking about how future interest rate cuts will be less aggressive than the big move we saw in September. So still those cuts coming. Does that worry perhaps market, because things may stay a little bit higher for a little longer than perhaps the market would maybe want, then giving a reason for some concern out of this market movement slowing for the remainder of the year and into next year?
That could be, but I think a normal pattern for markets is, and also to move in line with yields if the cycle is dominating. So if the cycle is improving, you can have a situation where equities go up and where yields go up. If it's more inflation driven, then the market is much more negatively sensitive for interest rates. And with inflation falling, we're moving into that different climate. We have seen the inflation dominance in the past year, and I think we're moving to that growth dominance. That would also imply that if growth really slows and yields start falling, that it won't save the equity market, because then there's the worry about growth. But I think what you see at the moment, that the market is able to withstand higher yields, fewer rate cuts. I mean, we think sort of a 25 basis point path going forward, maybe even skip one. The market has been able to cope with that because underlying growth is strong enough, and that is revenue growth, that is profit growth for companies, and then the market can handle it, I think.
There's a lot of reporting, there's a lot of analysis on the Fed, and it's very clear that it's still important, but is it in the driver's seat? And the reason I ask this is we look at the trade yesterday, one of the big movers was in the technology world, and it was Nvidia, based on the fact that you've still got money rolling through an investment in these mega chips, and that the earnings should still be very strong from here. And when we see technology out in front, in some ways it can be a defensive arm of the market where investors just trade a long-term theme. So do you think the Fed is still in the driver's seat?
Yes, I think so. I think so. What is interesting, when they cut with 50 basis points, there was the discussion that the Fed was too late, and acknowledging it basically, and that more had to be done, maybe behind the cycle. And now we're about a month later, and we're discussing whether the Fed should maybe slow down its rate cuts. So I think the cautious approach by the Fed, and laying out quite clearly what they intend to do, is the right thing to do at the moment. And they've always said they'll be flexible, they can accelerate, they can slow down. Now the data are more strong, they may slow down, but I think they're fully aware of the situation that's going on. And if growth is stronger, yeah, then they have to cut a little less than we thought maybe a few weeks ago.